All right, everybody, Economic Ninja, we're going to be talking about negative interest rates, their effect on the market, and why they happen. All right, guys, without further ado, let's do this. All right, everybody, thank you so much for hanging out today. We're going to talk about negative interest rates, and this comes from a great question from a follower. This is from David. Could you explain negative interest rates in detail on a future video? I don't know about detail. I don't have my cardboard with me, but we'll see. A friend of mine thought it was to encourage folks to spend their savings and not leave it in the bank. Please help provide clarity on the subject. Me and reading. Thanks for the honest advice. Absolutely, David. It would be my pleasure. So your friend is correct. There's a couple different forces here. Negative interest rates or even lower interest rates, okay? Because remember, we've never had negative before nationwide in this nation, but we've had negative rates in the world for about, I want to say the last 4 years. I want to say it was the first negative rate. I want to say Germany came out with the first negative rate bond. Anyway, my point being is this. It's pretty new, right? As far as the dawn of time, we've never seen negative rates until just recently. Now, that should scare the piss out of you, to be honest with you, because yes, it does encourage people to spend their money. That is the first, that's the low-hanging fruit in any banker's suitcase, okay? Because they can say, all right, if we can penalize you for holding money in your bank account by making negative rates. So to explain this, if we have a negative, if your bank, all of a sudden, when you first opened your bank and you had a savings account and it was yielding 1%, I know for you younger people, that has never happened. But trust me, there was a day, and there was actually a day where it was like 6, 7, 8%. That means you're in a good economy, okay? But a healthy economy. But we haven't been in a healthy economy since literally, well, actually really before the dot-com bubble burst. But really, I mean, we had higher rates in 2003, 2004. Not very good. But really, by and large, last 30 years has just been a complete just disaster economically. It's been fueled by debt, okay? That's really it. When you see growth, that doesn't mean it's always good. Growth doesn't always equal a healthy economy. It depends on how the growth is being done. What's producing the growth? If it is jobs being produced, all that kind of stuff, that's good. If it's because you could just get super cheap money and just build things and run over the top of other companies, that's bad. All right, sorry, I digress. So when you had 1% you're making in your savings account, and then all of a sudden the economy turns bad, most people don't understand it turned bad, but the effects were that the interest rate dives into negative territory, and now you're you are losing 1%, which means if you had $100 in your savings account and an entire year goes by, at the end, because you have a negative 1% interest rate being taken from you, you now have $99. Now, a lot of people would go, well, that's not that big of a deal, Ninja, because that's only $1. Well, the more money you have, the more money you lose, right? Sure, it's the same on a percentage basis, but you have to realize when that's happening and you're losing $1, what's happening is Slick Rick over here is coming into the bank and he is getting money, loans from the bank, literally at very, very low rates, because the yield, or stupid word, but the rate is at negative 1%. It doesn't mean you're getting a mortgage at negative 1%. You're usually getting you're getting the difference of what the bank wants to make in profit. So you're getting really low rates. Let's say 2% mortgage. He's taking out loans at 2%, buying homes and speculating, and because other people are doing the same thing, the house prices are going up, and then he's selling them and he's taking all his money and buying goods. So while you are sitting at home thinking you did a good job saving a nest egg for retirement, everything around you is going up in price because Slick Rick and all of his buddies are buying all these homes and buying cars and are speculating all over. This is exactly what happened during the Roaring 20s. So the savers are being just demolished, and I feel so bad for them because they're, especially older people that are on fixed incomes, those incomes are not going up at the rate of inflation. So they are literally being robbed. So what it does, and your friend David is correct, it now forces them when they wake up. And hopefully people are waking up now. And that's the point of this channel. That when they see that they're being robbed through inflation, they go, why would I hold the money? I'll take the money out and I'll go buy food. I'll prepay some bills, do all kinds of things to stop this robbery from going on. So that point is true. Now, there's a second aspect of negative rates that a central bank will use in its arsenal to combat issues, let's say. And that is actually about to happen, I believe. Right now, the Federal Reserve has got a serious problem on their hands. But to be honest with you, I think it might be, it's like, it's hard to explain. The reverse repo. Without getting into explaining what the reverse repo is, I want to show you it is a way in which the banks can go to the Federal Reserve and borrow money on a short-term basis to be able to deal with liquidity issues inside of the bank, okay? The reverse repo facility, or the repo facility, is open to all banks that are under the Federal Reserve's charter, and they can go and to access this money. Well, the Fed allows banks that have excess money to be able to put money on loan with them to be able to handle this with other banks. And that bank, let's say it's massive bank, I was like, hey, I got a ton of extra money. Like, what do you want to do with it? We're like, well, we want to make some interest. So we go to the Federal Reserve and say, hey, why don't we put it on loan with you, and then you can loan it out to the other banks that need it, and we'll make a small little interest rate, like a fraction. But hey, a little bit's better than nothing. It's just sitting in our bank making nothing, right? Those are excess reserves that we haven't went and loaned out in mortgages, loaned out in car loans, personal lines of credit, unless you're Wells Fargo, things like that, right? So the problem is, at a certain point, if that amount gets too big and the Fed can't use it all, and what's happening, the Fed's going, well, now there's all this excess money in this bank account that we'd usually, loan out to other banks. It's not getting used. And that means for every dollar that's sitting here, that's one less dollar that's being loaned out into the economy. So what do? They haven't done it yet, but they could. They could go, hey, banks, we don't like, this is too much money. And right now, there's a lot of money in that bank account. And so they go, well, we don't want you in there. And the banks are like, we don't want it. We want you to keep paying us interest. And the Fed goes, all right, we'll lower the interest rate down to negative territory. And now the Fed is penalizing the banks, which means the banks have got to go, oh, crap, the Fed just lowered our rate to negative 1%. So now they've got a decision. Just like the saver sitting at home thinking they did a good job with a nest egg, now the bank's going, crap. Now, what do you want to do? Do you want to take the 1% hit each year? Or do you want to loan it into the economy and loan it out at, a couple percent? So that, in a sense, would penalize the banks now too. So it's used twofold. I hope you guys understand that explanation. I'm trying to bring it down to the most basic explanation possible. I do believe, I'll close here, I do believe that we are going to see that repo facility continue to grow, and I believe that we are going to see the Fed run into negative territory. Now, but here's the problem with this. If the Fed does that, you have now completely destroyed the perception of the US dollar as being a safe haven. I think the only way that could happen, that the Fed would be allowed to do it and not totally tank the dollar, is if more and more countries run into negative territory. So that's the key, to start watching these other countries. And right now, I don't know how many, we had like $18 trillion of negative yielding debt worldwide, I believe like a month and a half ago, in the form of bonds. That's not that much money in the grand scheme of things. But as you start seeing that number get bigger and bigger, that means that the US dollar is getting closer and closer to negative territory. It can go either direction. We could have a complete bond freak out and all of a sudden rates skyrocket. And trust me, there's a point at which the Fed can't backstop it. I know that sounds crazy. The Fed can always print money, but no, they can't, because they're stuck between a rock and a hard place. Because if they just keep printing it, that also devalues the dollar. So yeah, they are now in a catch-22. They literally have two scenarios. Either way, we're there. It's just, how long is it going to take? Are we going to see the dollar collapse in perceived value and real value because rates went negative, or because the bond market freaked out and the banks go and the Fed goes, we can't just keep printing money, because that's going to, and if we do print more money, that's going to tank the perceived value and the real value of the dollar. All right, guys, hope that made sense to you guys. Please keep putting your comments below. I love them. Thank you, David, for that great question. With that being said, the Economic Ninja is out.